Australia has the second highest household debt in the world. And instead of fixing that, it feels like we are racing toward first place. The latest mortgage and debt numbers, they're finally out, and they show households are loading up on bigger and bigger debt at a pace that is getting very dangerous for some people. And this did not just happen. There is one clear culprit, someone we can blame, that's sitting behind this. And I'm going to show you exactly who that is. Hey guys, it's Scott here. Now this morning, my research team sent me a report on the latest mortgage and debt levels. I went through the numbers, I compared them to when we didn't have a housing crisis. I compared homeowners versus investors. I looked at everyday Aussies and what they're carrying now versus a few years ago. And I'm telling you, if you're struggling right now, if you're finding it hard to pay the mortgage, if the bills feel heavier every month, this report validates your pain in black and white. You are not imagining it. The numbers are maddening. And I'm not saying all debt is bad. Smart debt can build wealth. And there is a portion of the population that can afford to take on more and more debt and use that to buy up assets. And with all this inflation over the next 10 years, look for assets to inflate further. But when your debt gets so high that your lifestyle starts shrinking, when you're cutting back on everything just to survive your mortgage, that's when you stop and ask yourself, is it even worth it? What are we doing? What has housing become in this country? It's meant to be basic security. Instead, it feels like a lifelong financial chokehold. And that's not what it should be. Then you zoom out, you step back. The government is sitting on $1 trillion in debt that could double over time. Everything is getting more expensive. Rate hikes are looming. World international agencies like the IMF have already shaken the government and basically asked, what the hell are you guys doing? Your households are hurting. Your economy will hurt in the future, but what changes? Absolutely nothing. So in this video, I'm going to break it all down for you. I'm going to bring all the research and all the numbers right here so that you don't have to do that. I'm going to look at home buyers versus investors, how much debt we're talking about, what these numbers actually mean for your future, how policy decisions brought us here, and if nothing changes, how this is going to hurt many Australian households for a very, very long time. I'll break it all down in plain English, no spin, no opinion, just the reality, just the data, just the facts. So stick with me. Before we get into it, this is your daily property update. I cover property, policy, and the economy every single day so you can make the right moves. Hit subscribe, hit the bell so you can stay ahead and get all the latest information. Okay, let's get into it. Money.com.au looked at the official ABS lending data, and here is what jumped out. In the 3 months to December 2025, residential property lending hit $115.18 billion. That is the first time we have ever crossed $100 billion in a single quarter. Now, when you hear that, you might think people are buying more homes than ever before. And you might think that's why these mortgage levels are so high. Well, that's actually not what is happening. The number of mortgages written during that period is about 12% below the 2021 peak, which was during the COVID boom when money was practically free and interest rates were near zero. The record dollar number is actually coming from the size of the loans. The average mortgage today is sitting around $692,000. Owner-occupiers are averaging close to $694,000. Investors are sitting just under $689,000. In 2021, the average mortgage was roughly $555,000. That means the average loan has increased by about $137,000 in just a few years. That's a 24.7% increase. Since 2021, average loan sizes have jumped almost 24%. Ask yourself if your wages have risen 24%. Now, for the majority of Australians, that has not happened. Maybe the top 10 to 20% of Australians who are very fortunate in the right roles, in the right careers, in the right jobs, many have actually experienced really high wage growth. But overall, most Australians have not. These are not abstract figures that live in spreadsheets. These numbers translate into high repayments every single month. They translate into tighter budgets. They translate into you canceling things that used to feel normal. They translate into telling your kids maybe next year. They translate into your life orbiting around your mortgage. You're literally controlled and your spending is controlled. Your lifestyle is controlled by your mortgage. If you feel stretched, these figures are showing you exactly why. And just to make it heavier, wages are not actually keeping up. Inflation has been running ahead of wage growth. Even if you get a 5% raise next year, most of that will disappear into groceries, petrol, electricity, insurance, school fees, rent, your mortgage. So when you say it feels like you are running harder but not moving forward, that feeling is backed by data. And while households are stretching like this, there is another powerful force in the market that we need to talk about. Let's take a look at it now. Property investors now make up 39% of mortgage lending in 2025. That means almost 4 out of every 10 loans written this year were taken by investors. But before we go any further, let me clear the air properly. There are 2 very different types of investors in this market. The first group buys off the plan or funds new construction, exactly what we need. They inject new supply into the system. They actually add homes to the rental pool. In a country that desperately needs more housing, those investors are helping fix and helping fund the fix for the government's problem around housing. They are increasing housing supply, which is exactly what we need. The second group targets existing homes. They are sitting on equity built up over the last few years. They use that equity to outbid other buyers. They compete against first home buyers. They compete in the exact same affordable segment where first home buyers are trying to get their foot in the door. Now, you cannot blame investors for using the incentives and structures the government has created. They are responding to the system as it exists. But here is the part that hurts. The data shows that 82% of investor lending is for existing dwellings. That means most investor money is chasing homes that are already built. And those are the same homes first home buyers are also chasing. So let me paint this in real life. You save your deposit, you find a house listed at, let's say, $900,000. You've worked out you can stretch to $1 million. You feel prepared, you've done the math, you think you have a buffer. Auction day comes along. Standing across from you is an investor with equity and stronger borrowing power. They've got stronger borrowing power and more equity, more deposit because they already own property and they've become very wealthy because of owning property. They are comfortable stretching because they already have assets backing them and they know that rents are high and they're going to collect that rent. The bidding starts. 900,000 becomes 950, then 1 million. Within minutes, the house sells for 1.2 million. That is what happens when demand gets concentrated into the same limited pool of homes. And this is where government policy comes back into the story. When the government unleashes more demand into the market, but does not build new supply to absorb it, all that pressure piles into existing housing stock. Prices inflate, loan sizes inflate, mortgages inflate. And because prices keep climbing, buyers are forced to borrow more just to compete. So prices keep climbing and buyers are forced to borrow more just to compete. This is not random. This is the direct result of demand being pulled forward into a market where supply is not expanding fast enough. And while all of this competition is happening at auctions, something else is quietly telling us how stressed households already are. Let's talk about that next. All right, here is another important fact that you need to know. A lot of households right now are refinancing. Over 640,000 loans were refinanced in 2025 alone. That is a 20% jump from the year before. That is not something you shrug off. That tells you households are struggling and they are trying to lower repayments, secure better rates, or buy themselves some breathing room. Even internal refinances where people stay with the same bank but renegotiate have hit record highs, with internal refinances reaching 232,950 loans in 2025. People are not refinancing for fun. They are doing it because they are tight, they are stressed, and they are living paycheck to paycheck. And they will claw at any strategy that gives them even a little bit of wiggle room. So just to sum this up properly, on one side, you've got bigger mortgages being written, and on the other side, you have people who already have big mortgages scrambling to reduce the pressure through refinancing. That is what a system looks like when it is stretched to the maximum. And the danger with this refinancing, a lot of people to lower their repayments are simply extending their loan. So they're extending a 20-year loan or a 30-year loan to 35, 40 years, or even longer. Now, I still have not talked about the policy decision which has driven all of this demand. Let's look at that now. All right, guys, I have thrown you a lot of analysis and a lot of data points and a lot of numbers at you. So let me just summarize that for you. Households are taking on bigger debt because prices have surged. Wages are not keeping up. Refinancing is exploding because families are desperate for breathing room. Now, remember in the intro, I did say there's one culprit. Well, that culprit, surprise, surprise, is government policy. And it all gets pinned to the policy they packaged as the lifeboat that was meant to help first-home buyers. I swear these guys are so well trained. They walk out with the media grin, they sell it like it's some heroic fix, and they say this is going to help you get closer to home ownership. And what did it actually do? It set everybody on a timer. Even people who are not ready felt forced to jump in because they were told if you don't do it now, you will never catch up and the gates will close soon. And actually, that is true. So buyers pulled demand forward and they borrowed more than they otherwise would have borrowed because the whole thing was designed to create urgency and panic in a market which lacks supply. And this policy was the 5% deposit scheme. Now, the bank of mum and dad also got dragged into this because parents started pulling equity out of their homes and gifting their kids money without even expecting it back because they felt if we don't do this right now, our kids will never own anything. So what did the scheme do? It dragged demand forward. It took demand from 2029, 2028, 2027, 2026, and it dragged it into 2025. Now, what that means is we are seeing the market run away from us. It unleashed every demographic into the same market at the same time, and it absolutely smashed affordability. And the most brutal part is the part nobody wants to say out loud. The demand got a boost, but supply did not. Where are all the policies for supply? Construction lending has fallen while the rest of the mortgage market is blowing out. Owner-occupier loans for new dwellings fell 9% over the year. Investor loans for new dwellings dropped 4% over the year. Owner-occupier land and construction lending sat at just 56,686 loans over 2025, and that is 58% below the 2021 peak. So you have bigger mortgages, more investor activity, more competition for existing homes, and construction barely budging, which means the supply squeeze stays, prices stay under pressure, and households stay trapped in bigger debt. And when you zoom out even further, the scary part is this is being watched globally. International agencies like the IMF and OECD have already raised concerns about demand-side housing policies that inflate prices without fixing supply, and they have basically roasted our government for turning housing into a debt and speculation game instead of fixing the fundamentals of the market. So you tell me, when do we stop pretending this is help? And when do we start calling it what it is? Because if this keeps going, affordability is already collapsing and a correction does not stay neatly contained. It will spread through households, it will move into spending, affect spending, it'll affect confidence, it will affect jobs, and you end up with a country full of people who own debt instead of owning security. This is the reality. If you feel stretched, you're not alone. Millions of households are in the same position. The data confirms it. You're not bad with money. You're operating in a system that has become extremely debt heavy. So what do? You stop waiting for policy miracles. You protect your cash flow. You negotiate rates. You build buffers. You make decisions based on math, not panic. You educate yourself. Because right now, you cannot depend on politicians to safeguard your financial future. Now, of course, if you've bought property 3, 4, 5 years ago, 6 years ago, 10 years ago, and you're sitting on a huge nest egg of equity, well, that wealth has been generated because of these problems. And if you're using that equity to own 1, 2, 3 investment properties and collect that rent, highest rents we've ever had, then you are going to create a massive amount of wealth for yourself over the next 10 years. But is this fair to all Australians? Because right now, many families are being crushed under record debt, households are refinancing just to survive, wages cannot keep up, and mortgages are ballooning out of control. The government has just let $15 billion of your taxpayer money disappear into thin air. That is 15 followed by 9 zeros. Stolen, gone, funneled into criminal activity and scammers. And nobody right now is in handcuffs. If that does not make your blood boil, I do not know what will. If you want to know the full story behind this scandal, click the video on screen. My name is Kuru. This was your daily property update. I do all the analysis and all the research for you every single day so that you don't have to and so that you can become a property insider. I'll see you at the next video.